Thank you for joining me today. I'm going to discuss potential traps to avoid when planning for Social Security. This is this month's Ask Me Anything webinar. I'll have time at the end for questions as well. So the main topics that I'm going to cover: knowing your full retirement age, when should you start claiming benefits, what benefits you get if you wait to claim, some tax traps to avoid, also referred to as the tax torpedo, and also layer in potential Medicare implications. So these are the subtopics that I plan to cover, but if you have any related questions, please throw them in the chat and I'll be happy to address them. So when it comes to deciding when to claim your Social Security benefits, there are two primary considerations I want to focus on today. You want to maximize your benefits, and that's not just today, but it's for as long as you collect them. And the other thing is that there's some unique tax considerations you want to consider as well. These relate to how your Social Security income is taxed. We're going to discuss the Social Security tax torpedo a little later in the webinar, and also know that delaying the start of your benefits can also reduce future tax bills too. So where do you start? How do you even know how much you're going to get? Well, you can go to the Social Security's website and create a My Social Security account. If you haven't done it, this slide lists the information that you have to provide because you want to learn about your benefit. How much? They'll tell you what your benefit is if you start collecting at 62, what happens if you wait till your full retirement age, and what happens if you wait till 70. So all you have to do is just provide the information I listed here and be able to answer some questions that only you should know the answer to. Then you'll get an activation code to complete the process, and you need to create a username and password. And I also recommend that if you open up, when you open up your account, it's a good idea. You can put two-factor authentication on it so that when you go and log in, they'll send you a text that you have to put a code in order to be able to get into your account. It's just an extra precaution. So when is your full retirement age? I'll tell you that so many times that I speak to people, they still think it's 65. It's not. Your full retirement age, if you were born from 1953 to 1954, is age 66. And then for each year past 1954 up till 1960, it increases by 2 months for each one of those years. And then for those born in 1960 and later, full retirement age is 67. The longer you wait, as I'll talk about in a little bit, the more your benefit grows. And if you start to claim your benefits before you reach full retirement age, it can be costly. It can be even worse if you're still working. And I'm going to discuss that more on the next slide. So, can I still work while collecting benefits? You can, but you want to make sure you understand the ramifications, and it's different before and after full retirement age. If you claim benefits early, meaning before full retirement age, and continue to work, you may forfeit some of your benefits. If you haven't reached full retirement age, the Social Security Administration deducts $1 from your benefit payments for every $2 you earn above the annual limit. For 2021, that limit's $18,960. So you can earn $18,960 or less without having your benefit be reduced. If you earn more than that, your benefit's going to be reduced. In the year you reach full retirement age, the Social Security Administration deducts $1 for every $3 you earn above a different limit. For 2021, this limit on your earnings is $50,520. You should note that your earnings are only counted up to the month before you reach full retirement age and not the entire year. Then beginning with the month that you reach full retirement age, your earnings are no longer going to reduce your benefits, regardless of how much you earn. In other words, when you get to full retirement age, there's no penalty for working and collecting Social Security benefits at the same time, and your benefit is recalculated to give you credit for continued earnings and any benefits that were withheld in the past. And the other thing to think about is when your benefits being determined, it's not totally on this particular part about working and collecting benefits, but if you're still working in your 60s up till age 70, which is the point you have to start, those earnings years can replace some of your lower earnings years in your calculation so you can actually increase the size of your benefit. What they do is they take the 35 highest earnings years that you have, and they're indexed, though the later years, they no longer index them. But the earlier years, when you were working 30 years ago, they index those years to kind of take those dollars and put them more into today's terms. So the question is, when should I start claiming benefits? Here's some factors that can impact that claiming decision. If your health's failing, there's really no good reason to wait. Does your family have a history of living long? If it does, waiting until 70 can have a lot of benefits. Know that the break-even age, if you start at 66, if that was your full retirement age, versus waiting until 70, is about 81. At 67, that break-even point is about 82. And what I mean by that is that while your benefit grows, you're getting nothing for those years. So that's how long it takes till you get back to even. So waiting till 70 gives you a bigger benefit, but it's not till 82 that you're basically going to have the same amount of dollars if your full retirement age is 67. Another question is, do you need the money now? If you do, then you don't want to wait. Remember how the benefits are taxed and are lost before full retirement age? What's your earnings potential in that period from 62 to 70? Like I said, your benefit can actually increase if you're still working too. What's your marital status? This could be really important. I always recommend that at least one member of a married couple should wait as long as reasonably possible. If both members of a couple age 65 are in good health, there's a 50% chance that one's going to live till 95. And the thing to remember and why that's so important is that their surviving spouse gets to claim the higher of the two benefits when they're on their own. So you really want to see if you can wait. The first spouse, if there's a big income disparity between the two spouses, the first spouse can really start when they stop working, because their benefit's not going to increase anymore. And it's not like they're going to make up the benefit later on. The only way that the benefit could be a little bit bigger is if they claim the 1/2 spousal benefit, and then you have to wait till the higher earning spouse starts claiming. So even then, it still might not make sense to wait for that, for that person that's for that lower earning member of the couple. Also, what other savings do you have? Can you use them to bridge the gap while you wait and let your benefit grow? And there can be some really meaningful tax benefits that come with waiting. And then think about this, like so many people don't wait, even though there's benefits. Of those born from 1943 to 1947, only 4% first claim their benefits at age 70. And they estimate that we give up a lot of money by claiming our benefits too soon. Why should you wait? Well, first of all, your benefit's going to grow while you wait. The break even, if you waited from 62 to 66, if that was your full retirement age, is 77. Your life expectancy is about 85 and a half years at 62, and at 66, it's 86.2 years. Your benefit gets reduced by 0.5% for each month up to 36 months before full retirement age, and it gets reduced by 0.5% if there's more than 36 months. That amounts to a 30% reduction in your benefit from age 62 to age 67. The break even by waiting from 66 to 70, like I said before, it's 81. Your life expectancy at age 66 is 86.2. At 70, it's 87. And your benefit from full retirement age till age 70 grows by 0.2% each month, or 8% annually, from full retirement age to 70%. Workers who delay claiming benefits from age 62 to age 70 increase their benefits by at least 76%. That's an overall annualized return of about 7%. And why I say at least, it really depends on when full retirement age is. If it's 67, then it's going to be 76%, but those at 66, it's going to be even more, because they have more years to get that 8% growth in the benefit. As I said earlier, for couples, waiting to start claiming benefits matters even more, because the surviving spouse gets the higher of the two benefits. If the age difference is wide and the older spouse is the higher earner, waiting takes on added significance. I have somebody that talked to me about this. He was 10 years older than his spouse, but he was in a hurry to claim. And in that case, that's really not the right decision to start claiming it full retirement age while he was still working on top of it, because that benefit, he was the higher earner, is going to carry over to the spouse. And so her benefit is going to be much smaller than it could have been if they waited till 70. Claiming benefits before age 70 means lifelong permanent cuts in the monthly payments to you and your spouse. As I said, too, if there's a big earnings disparity, the lower earning spouse should consider claiming benefits earlier when they stop working. Also, you want to remember that up to 85% of your Social Security benefits are taxable. If you want to optimize your tax bill, you can benefit by waiting. And what do I mean by that? A lot of times, think of those years from like 62 to 70, depending on what your work status is too, as bridge years. There might be opportunities to use your retirement savings, like your 401k, your IRAs, to make up for what you didn't get from Social Security, because that's going to reduce your RMDs in the future when you hit age 72. And therefore, that can lower your tax bill in retirement. Also, depending upon your personal facts and circumstances, Roth conversions, where you take some of those IRA monies and convert them to Roth and pay the tax today, can also have benefits. And if you can do some of that before age 65, as we'll talk about on a later slide, then that can also have a benefit in terms of reducing your Medicare premiums. There are lots of things to think about, lots of different things that interact. And at the end, I have a slide with some resources and some places that you can look at some of these things on your own too. So I want to wait. How can I do that? Well, like I said, there's two things that you can do. You can use your tax deferred savings or your taxable savings to make up for the fact that you're not getting that Social Security benefit. You know, that 8% growth that you get, that's kind of guaranteed growth. And I can't think of any place you can get 8% guaranteed growth. And also remember that the decision to wait is not permanent. So if you were unfortunate and something happened and your health deteriorated and you were planning to wait till 70, you can turn your Social Security on before then. You don't have to, it's not like you tell the Social Security Administration, I'm waiting till 70 and you're locked into that decision. You're not. So why should I wait? Well, it's going to reduce your future RMDs if you take some money out of your taxes deferred savings now. It can lower your income-related monthly adjustment amount, which is a change to your Medicare premiums based upon your income. It can provide some long-term tax benefits. Your Social Security benefit will grow, and it can potentially help you avoid the tax torpedo. So there's lots of good reasons to wait. And just think, I show this slide a lot, but it's always relevant to me. We look at tax rates. Tax rates right now are the ones on the left of this chart, and I know it's kind of small, but those figures are the current rates. I know that there's proposals out there now to potentially increase rates. My view on tax rates is always, I'm going to take what the law is until somebody makes a formal change to it, because when I worked for Deloitte earlier in my career, I saw so many times that people talked about changing tax rates, and the big think tank guys in the firm would write about what they might mean, and then the laws never passed. So I wait till it passes before I do that. But something to remember is that the rules that changed at the end of 2017, they sunset at the end of 2025. So if there's no changes at all made to tax rates, we're going to have, right now, we have to have higher tax rates in 2026 and beyond. If you're a single filer and you're earning $100,000, your tax rate's going to go from 24% in 2021 rates to 28% in the 2026 rates. A married couple with that income sees their top rate go from 22% to 25%. At $160,000, singles are going to go up from 24 to 28, and a married couple from 22 to 28. Those are meaningful differences. And again, if you think about Roth conversions, they can have a lot of benefits, because you can potentially, this concept I call and refer to as bracket stuffing. I want to make sure that I take enough income to fill the 10% bracket, the 12% bracket, the 22% bracket, maybe even 24. I don't know that I want to go up to 32, but if I can take some income and fill those in based upon what my income looks like it might be in the future, it can make a lot of sense. So the next thing is to think about how much of your Social Security benefit is taxed. And this is it's a provisional calculation. No matter how much income you report on your tax return, know that at least 15% of it's not going to be subject to tax. So if you look at this table, it shows for a married couple with income of more than $44,000, 85% of the Social Security benefits taxed at the filer's marginal tax rate. If you're single, that limit is $34,000. If you have income of less than $25,000 if single, or less than $32,000 if married, then none of your Social Security benefits can be taxed. Next, we're going to look at the tax torpedo. What does that mean? So let's look at this chart here for a second. We have a scenario where an individual has 60,000, or a couple, this is a married couple, they're both over age 65. They have Social Security benefits of $60,000. They have pension income of $20,000. They have interest and dividend income of $1,000. They have municipal bond income of $500. And they were taking $10,000 from the IRA this year. That gives them provisional income of $61,500. They have a taxable Social Security benefit of $20,875. And the bottom line is that the tax that they're going to pay is $2,539. That's a 10% tax rate, and they're paying 12% on the last dollar of their income. Something happens and they need another $10,000 from their IRA. They have an unforeseen expense. Well, what that does is it increases not just their taxable income, but also their taxable Social Security benefit. It's going to go up because of the increase in income. So now, instead of having a tax bill of $2,539, they're going to have a tax bill of $44,759. It's going to go up $1,700. Their effective tax rate on their additional income is 22%. And their marginal tax rate didn't change, but they're paying at a higher rate because more of their Social Security benefit gets taxed. So if I need the money, what do I do? Well, if you have a Roth IRA, you can use that. If you have a taxable brokerage account, you could use that too. You might still be subject to tax, but remember that it's going to be capital gains if you have any taxes, and that's going to be a lower rate. So while your provisional income is still going to go up, the effect won't be as much because your capital gains tax rate is lower. This is one of the reasons why I think it's important to make sure that you have accounts with different treatment from a tax perspective. You want to diversify your account types from a tax perspective in retirement. Now let's talk a little bit about Medicare. So Medicare, your premium is in part based upon your income. You're required to make an income-related monthly, there's an income-related monthly adjustment amount, and that uses your income for 2 years prior. So in the year that you retire, or when you first go on Medicare, you can file with them and have an appeal to ask that an adjustment be made, because you know your income's going down for a reason that you can't control because you're no longer working. If you had unusual capital gains or something like that, that won't be accepted as a reason for you not to pay this increased premium. Think about this. If you're a married couple and your income went from $175,000 to $176,001, your Medicare premium is going to go up by $59.40 a month. That's the difference between the $207.90 in this table and the $148.50. I don't care if it's only $1 over. All you have to do is go over that level, and you're subject to the next premium. So in total, that's an increase of $1,425.60 in additional premiums. You're also going to pay another $240 of income taxes on that amount. That means your total cost for taking that extra $1,000 of income is $1,665. So your taxes are going to go up by $1,000 because your income, even though by $1,600, more than $1,600, even though your income only increased by $1,001. That's an over 100% effective tax rate. So you want to be careful here to avoid that. And again, these two traps should help reinforce the importance of diversifying your account types and not just your asset types. because you want to be able to have other accounts to pull from in order to manage your taxable income effectively. Here I have some additional resources. If you'd like to learn more, here's some things you can check out on your own. The first of the 3 online calculators, those first 3 items, those are all online calculators. It's free. The handbook that I have at the bottom, that's offered by the Social Security Administration, that's free as well. That first tool, opensocialsecurity.com, it has some advanced options. You can check a box at the top of the page if you want to use those. That allows for more customization. You can also factor in potential benefit cuts if you choose to do so. The default, if you want to do that in that software, is a 23% reduction in benefits beginning in 2034. That seems reasonable because that's what the Social Security Administration currently projects if there's not additional funding. And it's possible that there is additional funding because they have talked about it. Reinstating Social Security tax at income levels above $400,000 is one of the things that I've heard. And when I'm asked about it, I don't think Social Security is going away because I think it would be political suicide for any politician that took that benefit away from a large block of people, retirees. That version of the software also allows you to consider different situations such as divorce, widowhood, disability. You can tweak the life expectancy table if you want. And all that shows how sensitive your Social Security filing is to personal variables. Like I put my own data in just to see how it worked. And it tells you for my wife and I when we both should start based upon an assumed retirement date and some other information that I put in. Also on this slide, I listed a couple books. Mike Piper, the author of Social Security Made Simple, he's the one that his website is opensocialsecurity.com as well. So that's it for the formal presentation. I'm going to go over one more slide and then I will be open for any questions that you have. So, Price's business, it's continued to grow. It grows through personal introductions from people that we know and serve. And so as you think about who you could introduce to a prize, which we would really appreciate, here are some things that you can look for. We're looking for people who are interested in gaining a better understanding of when they can retire and what retirement might look like. They are typically experiencing some type of life transition, such as retirement, loss of a spouse or parent, divorce, sale of business, a major career change and inheritance. Another one is sometimes they're just trying to understand how to save for their kids' college. We definitely like to work with friendly people. As you can tell from today's presentation, people that are concerned about income taxes are usually a good fit because that's something, I view taxes and investing as joined at the hip. And any dollar that we can save in your taxes today is a dollar that you have to spend either now or in the future. Why pay more than your fair share? Also, it's important, people that we work with are be receptive to professional relationships. And typically they're considering simplifying their life by delegating their financial affairs to a professional. If you know somebody, you can give me a call at that number, or you can send them an email and we can arrange an introduction, and it's not any obligation. Nobody that I talk to is under any obligation to work with me, and initial consultation is always at no cost. If you're interested in signing up for a Social Security planning discussion, you can use this link to my calendar. You can also sign up for our distribution list if you're not on it. And as mentioned a couple times earlier, I'd be happy to schedule a call to help you go through your questions. I'm going to open up, allow people to talk. And if you have any questions, please feel free to chime in with any questions that you might have. And I'll give that a couple, if nobody has any, that's fine, but I'll at least allow for a couple minutes for that. And thank you for attending. You're also welcome, if you want, you can put a question into the Q&A as well. All right, well, if nobody has any questions today, again, I want to thank you for attending, and I will have another seminar the last Thursday in May, and it's going to be, the main focus is going to be on caring for aging parents. Thanks for attending, everybody. Have a great night.